I'd like to just take you through some thoughts on the tin price and the tin market, and kind of lay some context for the discussions that are going to be coming up in the following sessions. So this is a standard disclaimer. So I'm going to break this into three key questions. Firstly, has the tin price boom been long overdue? Well, clearly, if we review tin's performance over the last year or so, it's been nothing short of extraordinary, really. You know, you've seen prices up to the highs we saw in the last couple of weeks are up almost 3 times as high than the April 2020 low, or pandemic low, and they're up by almost double in 2021. And equally, you've seen extremes in the nearby spreads on the LME as well. So you've seen backwardations on an intraday basis up to $6,500 a ton, and that's coincided with very low stock levels, market illiquidity on the LME, and just generally a representation of the physical tightness that we're seeing in the global tin market, or have seen over the course of this year. Now, I think it's worth starting off by saying, although tin has been the clear outperformer in 2021, it won't be a surprise to anyone that tin has not been climbing in isolation. You know, a lot of markets have been performing particularly strongly. I think even more recently, last week, I think the energy markets clearly have been on a tear. But if we look at copper, you can see that there's been a very strong correlation historically in terms of the price between tin and copper. And I think this is really just a reflection of, you know, there are a lot of similar drivers related to the pandemic that have been supporting both metals and indeed commodities more broadly. So you think about things like the weaker dollar, the stimulus-fueled demand and post-pandemic recovery that we've been having. And then obviously supply issues as well. I think with copper, perhaps you saw those a bit more acutely in 2020, which is why maybe the rally in copper was maybe a bit more concentrated last year. Whereas with tin, we've seen those affect the market a bit more acutely, particularly in the first half of 2021. Now, I guess the question is, you know, why has it taken 10 years for tin to see a pronounced bull market rally? I mean, people have been talking about it. I've been talking about it for, you know, at least 7 years I've been covering tin, that the opportunities were there really for quite a sustained increase in prices. And what really dampened that narrative or held that back over the last 5 or 10 years? Well, I'm going to pick up on two key factors really for people that aren't that familiar with what's been going on with tin in the last decade. I think firstly, Myanmar really emerged as a very surprise source of mine supply. It kind of came out of nowhere really, and it filled the supply gap that was predicted and we saw occur in terms of declining production from very established producing countries, places like China, South America and Indonesia. And I think you can see actually over the last couple of years that, you know, the Myanmar production appears to have peaked, and now you are starting to see that more underlying structural decline, I guess, in some of those core sources of production. So, you know, that had taken the narrative, but now seems a bit more positive in terms of the price outlook. Secondly, you had a role of solder use economization. So that was a conversion, particularly outside of China, from more tin-intensive and solder-intensive methods of joining electronic components to circuit boards to less intensive methods. So that's through-hole technology to surface mount technology is the appropriate term. And that really offset a lot of the underlying growth in some of the end-use sectors like electronics particularly that we've seen over the last decade as well. What we're starting to see now is that transition in solder electronics mounting technology or component mounting technology starting to fade a little bit. That negative drive starting to fade. So maybe we can perhaps expect some more underlying growth in end-use sectors to be coming through a bit more clearly in the years ahead as well. Now, secondly, I'd like to talk about the key drivers as I see them for the coming months for tin. I think clearly, I mean, if we pick on Indonesia and Malaysia, I think these are the two countries ex-China where you've really seen some of this ex-China tightness being generated on the supply side. So Indonesia, we saw, you know, lows in terms of 12-month rolling exports and indeed lows in export levels, kind of particularly around Q1 this year. And in Malaysia, we obviously had with MSC, they had a furnace failures earlier this year and then followed by COVID restrictions. And you can see the impacts there on that chart on the right on the exports, at least through to July, where the data is available, but they have been quite subdued. What we're starting to see now is Indonesian exports the last few months have been picking up quite steadily. and Malaysia MSC is now back operating with 80% of their workforce. So perhaps ex-China supply is on the recovery path, although obviously with the prevalence of COVID in Asia, there are still some ongoing risks of fresh supply disruptions there. Now, in the near term, you've also got the demand pressures. These are just a few, but I think you think about as we come out of the pandemic, we've had this fading boost of working from home, where there was a huge demand for goods and for consumer electronics, and perhaps that's starting to fade. You obviously got high tin prices, and while I wouldn't say tin is particularly price sensitive on the demand side, it's definitely got to be a factor at some point, and in some sectors, particularly areas like tin chemicals, where there's more substitution opportunities. You've had semiconductor shortages, which I guess is a bottleneck in the electronic supply chain, and now we have these more macro concerns about China winter energy curbs and the fading impact perhaps of stimulus measures that have been in place for most of the last 12 to 18 months. The other thing I think would be interesting to see in Q4 is we've obviously had a period, particularly in Q2, Q3, where China was exporting a lot of material, particularly to Taiwan, a lot of metal to Taiwan, to fill this kind of ex-China supply tightness that we were seeing and reflected on the LME as well. What we've seen is that's really flipped now, although China's got its issues again with these energy curbs, and perhaps we're going to start seeing some more import flows into China in Q4 potentially. So there's less of an imbalance in perhaps the regional supply tightness and where that's really concentrated. It's a bit different to earlier this year. The other massive factor, I think one of the key factors, is the fact that we have such scarce levels of inventory at the moment globally. And of course, this chart here is just reflecting exchange inventories, but I think even off exchange, I think you can assume that you haven't got a huge amount of metal sitting around anywhere, particularly with the big backwardations that we've had earlier this year. So I think this is really a short-term issue that, okay, well, we think that things might start improving a little bit in terms of the market balance, but any fresh shocks, the market's got a very limited capacity to absorb those, and so the potential for big sharp increases in price again as a result of any fresh shocks is still very present. And as a longer term point, the fact that you have low inventories makes it very difficult to sustain. Nick, sorry, I think Nick's just popped on. I'll just mute him. So it makes it very difficult for the market to be able to sustain big deficits in the future. And I think any projections of imbalance that you're going to see in the next few years really is going to be rectified by price and balanced out by price. Now, as a third question, what are these record tin prices that we've seen sustainable in the long term? Well, I talked about some of the negative shorter-term demand drivers, but in the long term, there is some optimism there. Obviously, if you have some of this pent-up demand from supply chain issues, then perhaps when they start to ease, you could start seeing demand sustain a bit from that perspective. So, for example, the semiconductor shortages in electronics and autos. You've also got opportunities in the decarbonisation, and we've started to see that a little bit in renewable sector with good, strong growth in solar solders, particularly in China. So that's sols that are used for bonding in production of solar panels. You also have the ongoing proliferation of electronics in the world. Our homes are getting smarter, our cars are getting smarter, our lives are getting smarter really in terms of electronics, and that's a trend that is likely to continue. And perhaps we'll see that a bit more clearly, as I mentioned earlier in this presentation, from some of these fading headwinds from solder economisation and reduction of intensity of use in electronics as well, of tin and solder. In terms of supply, really, I think the fact that we have high prices is obviously an incentive for new sources of supply. And I guess, I haven't got really the time to go into detail on all of these, but perhaps we'll learn a bit more in the panel that we've got coming up. But I think really, you've got a lot of opportunities for recycling in terms of end-use electronics, but it's going to require high prices in terms of developing the technology to do that, an incentive to do that. I think artisanal mining, there's opportunities as well, but you obviously have other metals, things like gold have been performing quite well that, are almost in competition for tin for the artisanal miners. They're going to mine what is more attractive to them. And also industrial mining, I think I've picked up at least quite a lot more activity, a lot of tin project developers coming out of hibernation with prices where they are at the moment. But what I would say is investors, I suspect, is wary of seeing another Myanmar, another black swan. I think it's been quite a common theme in the last few decades in the tin industry that you get these new sources of supply popping up. So I think that we need some time and some price stability from where we are at the moment in order to encourage that investment and see that new supply coming on. So in a conclusion, I think that tin's vulnerabilities, its underlying vulnerabilities to acute shortages have been exposed by the pandemic and the situation that we found ourselves in this year. I think the scarcity conditions are likely to persist in the short term, but I think next year we're going to perhaps see them easing a little bit because of the post-pandemic normalisation. I think that perhaps we could see prices easing to maybe $25,000, $30,000 a tonne, something like that would be perhaps a more reasonable range. I think that in the long term, it's still very positive. Electronics proliferation and decarbonisation will underpin long-term demand, and therefore I think that a return to pre-pandemic pricing is therefore unlikely. I think this new supply that we are going to need, because existing sources are generally stagnating or in decline, is going to need pricing to be relatively stable at higher levels to provide an incentive for that.